What a perfect moment to capture. When it rains, it really pours.
What a time to be alive. I remember vividly, just a few months back, the general sentiments around investing in the US market was that regardless of how you allocate your capital, as long as you buy some of these high profile companies, you probably wouldn't do too badly because the US market generally just goes up. However, at least in recent times, you are seeing stories after narratives after data points suggesting the opposite. And people are getting increasingly concerned about how the US market is going to perform, at least in the short to medium term. Which is why in this video, I don't proclaim to have all the answers that you're seeking for, but I do hope that it can appease some of your concerns and to take stock of where we are at. And of course, with the guiding principle of being transparent, I'll be sharing with you my own specific portfolio moves, at least over the last 3 months or in the Q1 of 2025. And as the saying goes, when it rains, it pours, right? And for most investors, I believe the main challenge that we're trying to grapple with today is really the idea of a recession. If we do take a very long-term horizon or perspective, we know that economies tend to go through this boom and bust cycle. And particularly in a recession, things tend to turn pretty ugly because it will definitely hurt top-line growth rates, it will hurt bottom-line earnings, and a lot of all these very optimistic view of the future, especially translated into earnings multiple, will definitely be inflated as earnings come down. And now we can see that the projection for Q1 of 2025 has actually fell to a negative 2.8%, which is a pretty large contraction. 4 weeks ago, it was a positive 2.3%, and 8 weeks ago, it was a positive 3.9%. Next, we also see consumer expectations just falling off a cliff, with the high-income consumers exhibiting the sharpest decline. And if consumer sentiments continue to stay low, it will directly translate to many of these companies that are selling goods and services in the general economy. And interestingly enough, if you do a pulse check in terms of how investors feel about the stock market and how it will perform in the next 6 months, we have a lot more people feeling bearish about the financial markets. And when breaking down the sectors of the S&P 500, 7 out of the 11 are actually still positive year to date. And communications are only down due to Google and Meta, while telecoms themselves are still big winners. So this is very much an AI, Mac 7 and consumer discretionary sell-off so far. So suddenly, investing is no longer about buying the Mac 7. The Mac 7. Now, I took the liberty to try to compute the performance of the Mac 7 to understand what's their year-to-date performance record and also the drawdown from their peak. And this is what I've tabulated so far, and I've took the liberty to add Netflix onto the list as well. So just looking across these 8 names versus the benchmark comparison of the S&P and also the Nasdaq, so the indexes are definitely flirting around the correction/bearish territory. But if you use the benchmark of a 20% drawdown from the peak as a bear market indicator, you can see that out of these 8 names, actually 5 of them have already entered into the bear market territory, with only Microsoft, Apple, and Netflix still holding on strong. And Netflix particularly strong with a positive year-to-date return so far. So just looking at this, it seems like the Magnificent 7 group or category of companies are no longer the so-called sure-win bet. And funnily enough, I do think that some newer investors tend to forget that they're investing into equities that are of a higher risk profile. So when looking at some of these big tech companies that has delivered spectacular returns over the last 5 to 10 years, they think that, it's a sure-win bet. You can just buy into some of these companies and they are sold the story that they are one of the highest quality companies. They cannot lose money because they're so profitable. Their margins are high. They have such great growth prospects. And the entire market knows that they're great. And everybody's going to prop up their valuations. But just comparing the 2 benchmark index, specifically the Nasdaq 100 and the S&P 500, over the last 10 years, the Nasdaq clearly outperformed the S&P. But in order for you to sit through that whole Nasdaq compounding return, the price that you have to pay is definitely volatility. After this recent pullback, we are sitting at roughly around 20.5x. So you might ask, is 20.5x, is it high, is it low? And just by looking at the past 45-year history, if you do just eyeball in terms of where the median forward PE should be, I think it will probably be between 16 to 18 times. And at 20 times, some people might argue it's expensive, it's still overvalued, I don't want to buy. And to couch it into a better perspective, this chart from JP Morgan actually shows you the standard deviation of the general forward PE ratio of the S&P. And them trading at around 20x today, we are roughly around one standard deviation away from the 30-year average of roughly 17x. So you take this data for whatever it's worth, but as an individual investor, I prefer a bottoms-up analysis. I'm looking at specific companies and allocating capital myself, rather than just looking at a broad-based index and just judging it from the PE ratio and making a judgment that, whether the market is overvalued or undervalued. I do think that regardless of the general market sentiments or condition, there will always be companies that are undervalued. It really depends on only whether you are watching them and whether they are part of your circle of competence. And a very large part of looking at the price to earnings ratio in general is that it's a very simple, quick and dirty way to kind of establish some sort of a benchmark. Whether it's a good one or not, I think it's a separate discussion. But the sophisticated formula, and sophisticated with an inverted bracket, of a price to earnings is really dependent on the assumptions that you make. In this case, price is just an element that we quote from the market. And earnings, in this case, which is the denominator, is really the game changer. Whether you can accurately forecast the earnings out into the future and how good is your forecast is deterministic into understanding the valuations of where we are today. And specifically, at least based on the NFAB analyst consensus, we are still expected to grow earnings broadly speaking, at roughly a 12% rate for the general S&P 500 companies. And if a near-term recession actually comes into fruition, I think the road will be pretty bumpy ahead. And if you were to dive deeper into the three specific sectors that most of you are probably concerned about, that revolves around some of these major tech companies. First, we have our IT sector, the information technology sector. Looking at the IT forward PE, we are trading at roughly 25 times compared to the 20.6 of the S&P 500. And on the consumer discretionary front, they're at 25 times versus the 20.6. And looking at communication services, which have your two advertising juggernauts, which is namely Alphabet and Meta, that sector's forward PE is at 18.5 times versus the 20.6 of the S&P. And we can see that only communication services continue to stay below the S&P 500, with the other two, like IT, having Apple, Nvidia, Microsoft, and consumer discretionary with Amazon, Tesla, both of them are still trading at a relatively higher valuation compared to the S&P. And before that, just a quick shout out for Longbridge, specifically for my Singapore viewers. So Longbridge is actually a new broker in town that has a license with the MAS. And today, if you open an account with them using my link below, you get to enjoy lifetime commission-free trading for both the US and Hong Kong stock market. And in fact, their new user sign-up promotion is going to end at the end of this month. And by the time this video is uploaded, you probably only have a few days. And from what I heard, they're going to nerf some of these sign-up promotions. And in fact, for myself, I've already collected my free Nvidia share and also an 8% interest boost coupon. So all you have to do is to create an account, deposit 2,000 Singapore dollars, maintain it for 30 days, and also complete 3 buy transactions. And you get to receive $50 worth of options cash coupon, one Nvidia share, and also a 60-day 8% interest rate cut, specific to their money market fund offerings. In fact, for those of you with a larger capital base, you can actually maintain a net deposit of 10,000 Singapore dollars for 90 days and complete 5 buy transaction. And your sign-up reward will bump from an Nvidia share to an Apple share worth roughly 300 Singapore dollars today. And on top of this, you get an additional 18 Singapore dollars affiliate exclusive if you use my link below. It's an $18 exclusive plus $66 worth of options coupon plus $150 worth of Nvidia share, which works out to be around 11.7% on your $2,000 deposit for 30 days. I do think that this is an extremely attractive sign-up promotion. And don't forget, the sign-up promo only lasts until the end of March 2025. So for those of you who have yet to sign up, feel free to use my link below. So with that in mind, I think to focus back into where my own general take of the markets today, this is what I feel. I think in any case, regardless of whether you are bullish or bearish, I think there will always be a convincing story to justify these market movements. Therefore, I always find it very challenging to predict the short term, especially so for what's to come in the coming 6 to 12 months. So as long as I have a longer term outcome that I'm fairly confident that will happen, I think everything in between is just noise. There are also many talks about this so-called Liberation Day that's going to happen on the 2nd of April, which coincides with many of Trump's tariff guidance to appease many of these uncertainties. And a lot of people are begging on the day to be the day of whether the market will just have a V-shaped recovery, like some might suggest, or just tank until beyond recognition. I'm not too sure who's going to be liberated, the ones holding the bags or the stock market bears. So quoting a friend of mine, in my investing lifetime, no major crashes happen from a man-made date, especially around a specific event. Not .com, not subprime, not COVID, not 2022. So for those of you actually waiting on the sidelines for clearer signals, let me actually pose a challenge to you. So please write down maybe one or just a set of specific triggers or catalysts that you need to see before deploying your capital back into the market. And journal down your thoughts and reflections, especially during this market volatility, at least on a weekly basis. So I think it will help you with your reflection and your post after action review of some sort, to also help you keep your emotions and hindsight bias out of the equation. And especially for those newer investors that have the tendency to jump in and out of the stock market and then try to justify afterwards. So by writing everything down, I think it gives you no leeway to try to smoke yourself or to shift the goalposts in this case. And I think ironically or unironically, you should be happy, especially when consumer sentiments are just down the drain. And just by looking at the past 50 odd years, especially when consumer sentiments are at the rock bottom, you tend to have pretty strong S&P 500 returns moving onward from there. The natural question would then be, what now? I actually posted the range of performance of the Max 7 names onto my X account, and I've received a range of responses from people saying that they're holding and others are saying that they are buying. In fact, there is some that cheekily said that they're waiting for me to buy first, or even waiting for my buy levels. Specifically, I don't have particular buy levels or even indications of where the market would bottom, but all I can share is what I've personally been doing, at least for the first quarter of 2025. And for transparency's sake, this is my current portfolio allocation. And yes, of course, for those of you who are not new here, you probably already know that I'm a huge China bull, but clearly I'm also adding to my US position right now. And I've actually took away some feedback from the comment section down below, where some of you were saying that, oh yes, it's true that I see your entire portfolio position, but I actually don't know whether on a bullish bearish scale, are you very bearish and what is your cash position? It gives me a much more comprehensive outlook of my view. So taking into account that feedback, I've then added the line item of cash in terms of my overall portfolio exposure, and it's sitting at roughly 11.3% right now. And I think just a few points to take note is that firstly, I'm still a productive man in society. That's why I still have a full-time income that is constantly being channeled to build up my cash reserve. And secondly, I think it's to not read too much in terms of this percentage. Maybe yes, for somebody, if you have 50% in cash and 50% in equities, maybe they're being bearish or they're expressing a bearish view. And personally for myself, on how I look at this cash position, it just means my fairly liquid asset that I can get hold of the money within the next 1 to 2 weeks. So things like cash in the bank, money market funds, this is where I qualify under this line item. On the flip side, I do own a bit of bonds here and there, but they do have specific purposes for my upcoming live events, so I do not include those into my cash position. But just trying to read this number, if let's say this month I have 11% cash, next month I suddenly have 15% in terms of cash position, it does not mean that I suddenly turn more and more bearish. Maybe if it's a very huge leap in terms of percentage, maybe you can make that sort of guesstimate. But for now, I think letting it sit between 10 to 15% is something that I'm comfortable. And more importantly as well, if the market continues this downward trajectory, I do expect my cash allocation to slowly tend towards 0%. Because at least for my own working theory, I do like to stay completely or fully invested, even or especially so in a bear market. Now, moving on to my Q1 movements. The one on the left is mostly in the US market. The one on the right is what I bought in the Hong Kong market. So you can see that I'm buying some of your Max 7 names, specifically Meta, Amazon, Nvidia, and also Google. And you can probably also observe that I have a fixed DCA to the VOO, which is $500 per month. And I think for closer friends in real life, you probably would know that I'm getting increasingly bullish on Meituan. That's why I'm starting to build out my conviction and position accordingly, so that building of Meituan position accounts for all of my Hong Kong buys. I did not add to my two core position, which is in Tencent and Baba, for quite some time already. Now, I think to just give you a perspective or flavor in terms of how do I add to some of these positions, let's just take Meituan for example. Just looking at these 4 arrows and the 4 candlesticks per se, can you notice a pattern? So generally speaking, I tend to buy on red days. They tend to correct down multiple percent, 2, 3, 4 percentage points. And there is some sort of a working theory or narrative or story that they want to build around the company. That's why Wall Street is basically throwing down. I don't know. I think it's just a psyche that most investors have to be comfortable with. When your portfolio is down, means that stock prices are getting cheap, means that you're getting a better deal. That's why you need to start buying. Rather than having the feel-good factor that, oh, my investing portfolio is going up, all the stocks are going up, that's why I feel a bit of FOMO, fear of missing out, and then I buy into those positions. So you can probably hold me accountable to that. I'm just going to show you, you can take a screenshot. If you are free enough, you can just kind of tabulate or match some of these dates. And I do believe that for most of my buys, I actually do buy them on red days rather than FOMOing into green days. Of course, with certain exception, maybe that day was a very lucky day or auspicious day for myself. But that's it. I think just looking at some of my bigger buys, they were in 4 tranches, which is mainly end of Jan, start of March, mid of March, and end of March. Just a short reflection amidst this ongoing volatility. I think you have to recognize the fact that you are at the mercy of Mr. Market. You cannot order the stock like you go into a restaurant and order your meal of what you want to buy and then ask them to go on sale. So I think going back to using the Adobe example, I did buy Adobe at the start of 2025, and back then I believe many of these companies are still holding on strong. That's why I could only observe Adobe as a potential opportunity to buy. But I think in recent times, I think Adobe alongside many of these other names all took a significant beating. So yes, I am still bullish. I want to add to my Adobe exposure, but there are other priorities or other companies that I have a larger conviction in. That's why my capital, it's not infinite, so I have to manage my capital discipline. And I only can just add it slowly rather than trying to build out a bigger position, because it's really scaling based on your own conviction and how comfortable you are in some of these names. So just keep in mind in terms of your watch list and your portfolio of companies and how do you allocate the capital. There's no right or wrong. It's really much of an art than a science. So when Mr. Market throws a tantrum, all of them suffer, then you have to really prioritize your capital onto those companies that you think have a high risk reward and for companies that you are more comfortable holding. I think market timing is of course highly discouraged, and I was probably extremely lucky on my meta call. For those of you who do follow me on a regular basis, you know that I actually sold out a bit of my meta to recoup some of my capital, and then I've been slowly adding back in at a much lower price. So I do attribute that transaction largely to luck, but I think it's also always about portfolio sizing and allocation. Especially when you are looking at some of these large compounders, you always run the risk where you sell and the stock never comes back below your entry price, or in this case, your exit price. So usually, I think more often than not, when there is a broad market weakness, everyone's valuation actually take a hit, especially the higher beta ones. And if you're talking about a general category of stocks, specifically like the Max 7, most of them tend to suffer together, and some more often than the others. And then you get distracted into thinking, oh, everything is on sale, which one do I add, and stuff like that. And then the natural question is there really a point in just buying 1 or 2 shares here and there? For myself, I think it's really more of a capital allocation and just how big is your portfolio. If you're running a few $1 million, yeah, buying 1 or 2 shares doesn't make sense. But at least while I'm trying to build out my position, slowly but surely, I do see things compound. Everything, you need to start from somewhere, and compounding takes time. So don't feel discouraged that you're just buying 1 or 2 shares like myself. I don't think so. I think I've spent quite a bit of time trying to build this portfolio, and I'm quite proud of this. So just dollar cost averaging in, buying a bit here and there, whenever the market goes down, I think it gives you a feel good factor, because you won't look like an idiot if you just buy one whole lump sum and it just keeps falling down. So it's much more managing of your personal investing psychology. That said, I always err on the side of keeping at least some monies to deploy, and the cash position should be a floating rate. And I expect if the market continues to dump, like I alluded previously, the cash position would tend towards zero, even with the additional capital injection coming in from the monthly income and whatever your income sources are. So just to kind of end off or wrap up this entire discussion, Mr. Buffett, the legend himself, this is what he has to say in terms of holding a cash position. So over a period of a good many years, I have known a great many people who at some time or another have suffered in various ways simply because they did not have ready cash. So I've known people who have had to sacrifice some of their holdings in order to have money that was necessary at that time. So for a number of years, I've made it a point to keep a reserve should some occasion come up where I would need money quickly without disturbing the money that I have in my business. Thus, I feel that everyone should have a reserve. And should the time come when you need the part, I would suggest that you use as little as possible and replace it as soon as possible. So you might feel that this should be invested and bring you an income. Forget it. The mental satisfaction of having $1,000 laid away, where you can put your hands on it, is worth more than the interest it might bring, especially when you have the investment in something that you could not realize on quickly. So I hope that this video gives you a better perspective into understanding the current market sentiments and how to better navigate this whole exercise of portfolio allocation. And with that in mind, I'll see you in the next video, and hopefully in 2025, I'll see you guys on the moon. Goodbye.